A 100-point credit score increase can save you over $100,000 in interest across your lifetime. Same income, same job, same house, different credit score. And most people have no idea how powerful that number really is. Emma didn't get a raise, she didn't win the lottery, she didn't start a business. She just fixed her credit score in 90 days. Today, I'm breaking down exactly how she did it, step by step, and how you can do the same. The problem: why most people stay stuck. Here's the truth. Most people treat their credit score like a school grade. They check it once in a while, they feel good if it's high, they feel bad if it's low, but they don't understand it. And what you don't understand, you can't control. A low credit score costs you higher car loan rates, higher mortgage rates, higher insurance premiums, security deposits on apartments, even job opportunities in some industries. A credit score isn't just a number, it's financial leverage. Think of it like a reputation score for borrowing money. If lenders trust you, they reward you with better terms. If they don't, you pay more. Simple. Emma realized something most people don't. Raising your credit score is often easier than raising your income, and the return on effort can be massive. Quick basics. What is a credit score? Before we jump into strategy, let's simplify. A credit score is a 3-digit number, usually between 300 and 850. In the US, most lenders use FICO. Your score is based on 5 main factors: payment history, credit utilization, length of credit history, credit mix, new credit inquiries. That sounds technical, so let's make it simple. Imagine your credit score is like a fitness score. Payment history: did you show up consistently? Utilization: are you overworking your system? Length of history: how long have you trained? Credit mix: do you handle different workouts? New credit: are you taking on too much too fast? Emma focused on the factors she could control immediately, and that's what changed everything. The solution: how Emma raised her score by 100 points. 1. She fixed payment history first, the biggest lever. Payment history makes up about 35% of your score. It's the largest factor. Even one missed payment can drop your score significantly. Emma did 3 things immediately: set up automatic minimum payments, paid off any past due balances, and contacted creditors for goodwill adjustments. Let's explain that last one. A goodwill adjustment is when you politely ask a creditor to remove a late payment if you have a strong payment record otherwise. It doesn't always work, but sometimes it does, and it costs nothing to try. Think of payment history like trust. If you break trust repeatedly, it's hard to rebuild, but consistency rebuilds it fast. Emma didn't miss a single payment for 3 months. That alone boosted her score significantly. 2. She lowered her credit utilization, the hidden power move. Credit utilization means how much of your available credit you're using. If you have a $10,000 limit and you carry a $5,000 balance, you're using 50%. That's high. Experts recommend keeping utilization below 30%, but here's the insider number. Under 10% is ideal. Emma did something strategic. She didn't close cards, she didn't cut up accounts, she simply paid balances down aggressively, and she spread small balances across multiple cards instead of maxing one out. Think of utilization like carrying weight. If you're maxed out, lenders see stress. If you're using only a small portion, you look stable. This one move alone raised her score dramatically, because utilization is about 30% of your score. 2 biggest factors: payment history, utilization. Control those, and you control most of your score. Number 3, she didn't close old credit cards. Common mistake. Many people think, I paid it off, I'll close it. Bad move. Length of credit history matters. Closing old accounts shortens your average history. It can also increase your utilization ratio by reducing total available credit. Emma kept her oldest card open, even if she only used it for one small subscription. Think of credit history like a tree. The longer it grows, the stronger the roots. Don't cut down your oldest tree. Number 4, she limited hard inquiries. Every time you apply for credit, a hard inquiry appears. Too many in a short period signals risk. Emma stopped applying for new credit for 90 days. No store cards, no random pre-approvals, no unnecessary applications. Hard inquiries usually stay on your report for 2 years, but impact your score mostly in the first few months. Patience paid off. Number 5, she became strategically predictable. This is subtle. Lenders love predictability. Emma paid her balances before the statement closing date, not just before the due date. Why does that matter? Because credit utilization is reported when the statement closes. If your balance is high on that day, even if you pay it off later, it can still reflect high utilization. So she paid early. Small timing shift, big impact. The psychology of credit scores. Here's something important. Credit scores are not emotional. They are mathematical models. They don't care about your intentions. They respond to patterns. If you treat your credit like a system, not a personal judgment, you gain control. Emma stopped feeling ashamed of her credit score. She treated it like a project. Data in, optimizations applied, score improved. That mindset shift matters. The alpha tip, the 30-day rapid boost strategy. Here's what most people miss. If you need a quick boost, say before applying for a mortgage, you can optimize utilization fast. Pay all credit cards down below 10% before the reporting date. Even better, ask for a credit limit increase without a hard inquiry if possible. If approved, your utilization ratio drops immediately because your available credit increases. Same balance, higher limit, lower utilization. Instant improvement. But here's the nuance. Only do this if you won't increase spending. More credit should mean more breathing room, not more debt. That's the insider distinction. What 100 points actually means in dollars. Let's talk real impact. Imagine 2 borrowers. Both want a $300,000 mortgage. Borrower A has a 620 score. Borrower B has a 720 score. That difference can mean a full percentage point or more in interest. Over 30 years, that can cost or save tens of thousands of dollars. Same house, same income, different invisible score. That's why I call credit your invisible wealth. It doesn't sit in your bank account, but it determines how expensive your life becomes. Mistakes Emma avoided. Let's quickly highlight what she didn't do. She didn't hire expensive credit repair companies. She didn't dispute accurate information fraudulently. She didn't open unnecessary accounts. She didn't close old cards emotionally. She focused on fundamentals. Credit repair is usually behavior repair. Simple. Long-term credit mastery. Once Emma crossed into the good score range, she didn't stop. She maintained low utilization, automatic payments, minimal hard inquiries, old accounts open, and responsible borrowing. Credit improvement isn't about tricks, it's about discipline over time. Think of it like compound interest. Small, consistent actions build exponential results. Missed payments compound negatively. On-time payments compound positively.
And here's something powerful to remember. Your credit score doesn't just affect loans, it affects opportunity timing. When a real estate deal shows up, when a business opportunity appears, when rates suddenly drop, you don't get months to prepare. You either qualify instantly or you miss it. That's the hidden advantage of a strong credit profile. It gives you speed. And in finance, speed creates leverage. Emma didn't raise her score just to feel good about a number. She did it so when opportunity knocks, she doesn't have to scramble. She can act immediately. And that's the difference between reacting to life and being financially ready for it.
Final perspective. Your credit score is leverage. It can make your financial life cheaper or more expensive. It can open doors or quietly close them. And the best part, it's fixable. Emma didn't need a financial miracle. She needed a strategy. And so do you. Because wealth isn't just about how much you earn, It's about how efficiently you use the system. Credit is part of that system. Master it, and you lower the cost of building your future. If this breakdown helped you understand credit differently, hit like. If you want more strategies that turn complex money systems into simple action plans, subscribe. And if you're serious about building real wealth, watch the next video where we break down how to leverage good credit to build assets, not debt. Your credit score is invisible, but its impact is very real. Start treating it like wealth and watch what changes.